While most Americans are waiting for interest rates to get lowered, for them to jump in to their next home and for the prices to come down, I think savvy investors understand this one thing about interest rates that most don't. I want to help you understand. I know everyone is waiting to see those interest rates plummet, and I can tell you that my personal belief is that they will. However, I will say I don't think that the market is going to behave like people think. I'm Tucson Tom DB, and I'm a licensed real estate agent here in the state of Arizona. Today, I wanted to go into a little bit about how interest rates affect price. Most people think lower interest rates means more affordable homes, and to some extent and in some time frame, I would agree with that. But in general, and this is from Investopedia, I quote, rising interest rates curb inflation, while declining interest rates tend to speed inflation. Now, what does that mean? Well, when interest rates decline, consumers spend more as the cost of goods and services are cheaper. Increased customer spending means an increase in demand, and an increase in demand increases prices. End quote. That is so important. And when it comes to homes, higher rates can lead to slower markets. Those slower markets will lead to impacted prices, either slower moving prices or potentially even declines, as more and more buyers are priced out based on interest rates. When those interest rates are reversed, however, historically speaking, demand will increase. The lower mortgage rates will boost affordability temporarily, attracting more buyers and potentially lead to a faster growth of home prices. We saw interest rates plummet during the COVID pandemic, and at the time it was a blessing for many. But unfortunately, the double-edged sword, the other end of that was that we saw rapid price appreciation in many markets, doubling or even tripling home values. And unfortunately, that may be partially a new base. We have yet to see many markets dip below those newfound highs. And of course, some markets are reverting back to their mean. With the low interest rates during the pandemic skyrocketing prices upward, because at that point, businesses and larger investors had tons of money and they didn't know what to do with it. So plowing it into investments such as land at low interest rates for 30-year mortgages made a whole lot of sense. The Federal Reserve had to increase rates in order to slow the market down. I've seen many markets give up or at least pause some appreciation in recent times. And this is exactly the effect that interest rates being higher is supposed to have. And so the Federal Reserve, despite the fact that it's seen as hurting home buyers' opportunity, is actually saving them, in my view, from potentially having much, much worse prices. All of these big companies popping up in order to buy property quick at those interest rates are now faltering at the much higher interest rates. As you can tell, selling much slower. If you look into, say, the likes of Open Door and such companies, those companies are having a much harder time these days since the pandemic, where those low interest rates spurred the investors and the companies to buy as much land as possible. Personally, I think I see an economy sitting on the edge. And if interest rates get lowered at the wrong time, we will see it topple. So much rests on inflation not getting out of control. And I think at a time like this, when you can see some inflation coming from tariffs and you wonder, who will be right? Will it be transitory, or will it be permanent inflation?
Those price increases largely reflect higher tariffs rather than broader price pressures.
In which case, will we have a huge issue lowering interest rates into this inflation period where we're going to see much higher prices and truly only the rich able to get their hands on assets which are going up at a high rate?
Beyond the next year or so, however, most measures of longer-term inflation expectations remain consistent with our 2% inflation goal.
The Federal Reserve does not have 100% control when it comes to interest rates when buying your home. However, they are typically tied to the 10-year Treasury interest rate, and all of that is highly correlated to the the interest rate that the Federal Reserve charges. This interest rate is what the Federal Reserve charges banks to hold their assets and not to get too deep into a complex process, but that sets what the banks are willing to charge their customers, therefore their home buyers. There's so much that goes into home values in different markets, in different areas. As you can tell, if you look at a chart of home prices in New York versus Texas versus Tucson, Arizona, there's going to be different levels of appreciation. And that's all while the same on average mortgage rate, same general mortgage rate is being issued across the nation. So what does that mean? Well, you can't necessarily trust just one data point, and your market may be different. But what I can tell you is that on average, a slower market is going to be more advantageous for buyers. Ultimately, I don't believe that we should buy based on whether interest rates are higher or lower. The more I learn, the more I realize it's all based on the deal and what value it holds to you, the buyer. I'll say right now, the potential to get in easier at maybe a time when we're seeing more price drops and a slower market versus getting in later and watching home prices rapidly appreciate and having your offers more often rejected for higher offers with better terms and more investors potentially getting in at lower rates. I think it's advantageous to go for the former and to potentially buy earlier if you have the finances, if you have the home that you want at the right price. I don't think it's necessarily advantageous to wait for those lower mortgage rates. In fact, I could see a market in which those lower mortgage rates are actually detrimental to first-time home buyers or lower income home buyers who are just starting out with their first step on the journey and ladder of better, let's say, income retention. The bottom line for me is you don't want to let interest rates stop you from looking into finding your ideal home. Now, prices may fluctuate. There are market cycles that take decades to play out, and you may or may not have the very best price on a home, historically speaking, right? You may see a home at double the value today, and unfortunately, that might be the new base level. We just don't know. What I can tell you is that if you find a place that you like and you think you can afford it, it's probably worth looking into. And anything is negotiable in terms of price. And I can tell you this, as your agent, I'll make sure to get you the very best price possible today. And in the future, if interest rates do go down, you'll have already locked in that great price and you can refinance to a better, more advantageous interest rate, which will give you an even better monthly mortgage. Of course, there's the scenario in which interest rates have you priced out entirely of your ideal home. And in that case, don't worry, I've got the remedy for you. Stay tuned in future videos. Hit that subscribe button and I'll inform you of the very best ways you can buy a house that's out of your price range based on the current interest rates with a few simple steps. And for more of my thoughts on inflation, check this video out. Thanks. Have a great day.